So now I want to talk to you about the glide path method. Anyone heard about the glide path method so far? My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, and I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income, and most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life, because it cannot happen without a commitment. And it is my commitment to make sure you get all the support that you need to walk and achieve that destination. It's very common amongst financial planners, although they might not know the name, but they still might be doing it consciously or subconsciously. So I'll show you this with example of the screen of this picture. This, let's say a person is trying to do retirement planning. Okay. They are 45, as you see here, is the number of years to retirement, then 25 years to retirement. This red triangle is the target date of retirement, and 7 is basically post the retirement time. Okay. When they're 45 years away from retirement, they're young. When they're 25 years to go, they're in the transition. The last 7, the triangle to 7 is basically the very end of the transitionary period. And after then, they are late into retirement. That they should have retired after 7 there, they should have already retired. They're already late right now. This triangle says, this picture shares that, let's say you're investing in US stocks, because this is an example of America, but you can take that into Indian context. When you are young, when you're 45 years from your retirement, you can put 60% of your money in stocks. You can put 20%, let's say, or 25% of your money into international stocks, and you can put 10% or 20% of your money, 15% of your money into bonds. But then when you hit 25, you need to start decreasing your equity stake drastically year on year, and your international exposure as well. But you need to start buying more bonds. And when you are, let's say, 10 years away, you also need to start buying treasury or inflation protected securities like RBI free floating bond. Like, that's inflation protection security, right? Because it goes up and down with the inflation going up and down. And then when you are just 5-7 years away, then you also need to start adding cash into your portfolio, and also have more of the inflation security bonds and more of the nominal bonds, and then further decrease your international stocks and the Indian and the American stocks or Indian stocks that you have. And once you are in retirement, then all of this again goes into a fixed percentage. So effectively, there is a glide or downward slope in the equity or the riskier assets as you move close to your retirement. The reason why, well, it's good and bad what you've seen. It's good because without using a lot of mind to it, just putting certain percentages, you are able to literally define how much percentage to allocate. You simply follow the allocations all the way through to your retirement. It will be most beneficial for someone who starts very early, but in most of our case, that is not relevant. Another problem that this has, and I would like to show you, is that this does not take into consideration the fact that people do not have the appetite to invest 80% of their money into stocks, into volatility, into seeing a big paper loss. So the mindset equally has to be aligned. It cannot only be simply just percentage allocations. This is somewhere close to a static asset allocation, which you can fix year on year as well, right? But the method that I find more valuable, but it's a bit complex, is that of when you give valuations the priority. Why should I invest into the stock markets with 80% of all of my money into stocks when I already know that the markets are way overvalued? Why don't I reduce my allocation, not totally, but at least by 20%, even if I'm young, and put that money into gold, which equally can give me an equity type return over a period of time? So there, that consideration is that of valuation more than just fixing a percentage that this year 80% into stocks. But then you're not using any allocation to you're just using allocation, you're not using valuation. You're not looking at the worth of what you have. You're just saying कि इतना पैसा मैं इसमें लगाऊंगा, fix है. That approach will give you returns, but it will make your journey very uncomfortable because it will bring a lot of volatility. And as much as I know, people don't like volatility, especially Indians, especially when it comes to retiring your retirement money, and especially when it comes to not just looking at a portfolio, when it comes to looking at the entire wealth, because that is all we have created. And we need to always follow Warren Buffett's rule at never lose money, rule number 1. Rule number 2, never forget rule number 1, which is never lose money. So the mindset equally plays an important aspect. So the equity glide method is a great method if and only if you can stomach the volatility. The better method is giving valuation the precedence over this, moving your assets one to another based on the valuation that you are creating.